So part 2 of section 13-1, we're going to look at the last two objectives. So if you recall, common objectives for financial information and analyzing it was to look at financial strength, profitability, efficiency, and market value. So we're going to do the financial strength, just the first one of those. So when we talk about financial strength, what does that really mean? What it means is it's the company's potential to generate enough funds to pay off all its financial obligations, its liabilities, financial obligations, liabilities. And you can then look at paying off short-term obligations or liabilities or long-term. So we're going to start with the short-term ones. And there are 3 different short-term financial strength ratios that we're going to look at. But as a matter of a little background, it says here that a successful business needs adequate capital. And I can get capital, as you know, from 2 different sources. I can either borrow it, a liability, or the owner can provide it, or retained earnings can provide it. So equity. So equity financing, debt financing. And I use the capital from that financing, whichever one, to invest in assets or to pay expenses. And our assets, we have long-term ones that are plan assets, and we have short-term ones that are current assets. So we use the capital to invest in these assets or to pay off expenses. So there are 3 of them that I'm going to go through. So working capital is the first one. And that one is the amount of total current assets less current liabilities, is known as working capital. It's stated in dollars, and it's the amount of current assets that are available to the business to utilize after current liabilities are paid off. The key is current assets. It's not the cash that's available to the business. It's all current assets that are available after current liabilities are paid off. And hopefully you're just taking notes on your Blackline Masters, because that's probably easiest. So for Forrest, I forget the name of the company, Forrest Company or something like that, they did these calculations using the total current assets and liabilities from the balance sheet. So I would first note that these numbers all come from the balance sheet. And you can see that it went from $140,000 to $201,000, which tells me that it is a favorable trend, that things are good and improving. And page 373, if you take a look at that, it talks about, in the last paragraph on that page, about Forrest expansion and how that impacted the amount of inventory and liabilities that they had, which resulted in this working capital being pretty low this first year, but then getting a lot higher in year X3. So this, I would say, is a good thing, and we would want to continue to try to increase our assets without increasing the liabilities. So again, we calculated it. We compare it to a trend or standard, which would be that we wanted it to go up, and then based on that calculation and analysis of relationship, we would talk about in the future what we would want to do. And we talked about that already. So I'm going to do that on every single one of these ratios. So the next one that we have that is commonly used to look at short-term financial strength is current ratio. So that's the second one. And it measures the relationship of current assets to current liabilities. And it is literally just taking total current assets divided by total current liabilities, whereas working capital subtracted them. This one's doing divided, so it's looking at the relationship to current liabilities. Normally, and I would maybe add this to my notes, normally current liabilities are expected to be paid from the cash that we already have on hand, or from the cash that we expect to receive soon from our other current assets. So accounts receivable, marketable securities, those kinds of things. So here shows the calculation again, which is the first step in analysis of the current ratio for Forest. And again, I would note that current assets, current liabilities comes from the balance sheet. And for instance, when I compute this and I get 2.5, what that's saying and what that means, which I would make sure I know, is that I own $2.50 of current assets for each dollar that's needed to pay current liabilities. So I have $2.50 of assets to pay off $1 of current liabilities. The target in their industry, and it's normally by their industry that you look at this, at what other companies are doing and what's expected. The target is 2.0 to 3.0. And you can see that for both of these, they are in that target range, although last year not so great, but better trend now. And the other thing I would note in my slides is if you're less than 2.0, there's an issue about whether or not you're going to be able to raise enough cash quickly to pay off your current liabilities on time. You're starting to slide, it may be difficult to meet your short-term obligation. If you're greater than 3.0, you would think that would be great, but if you're greater than 3.0, what it's saying is you just have too much capital invested in those current assets than you need to run your business day to day. So too high can be bad as well. The third ratio that we're going to talk about is the quick ratio, and it is also used pretty often by banks and lenders along with the current ratio. And it is looking at cash and other current assets that can be converted quickly, hence the quick ratio. And those quick assets are the incredibly short-term ones. So cash, accounts receivable, marketable securities, 3 months or less, but not merchandise inventory or prepaid expenses. So make sure you know which things are included in quick assets. And the ratio measures that relationship, quick assets to current liabilities. So instead of current assets over current liabilities, it's now quick assets divided by current liabilities. And this is also known as the acid test. And this truly shows their ability to pay all its current liabilities pretty much immediately, within a month or two as opposed to over a whole year. So that's the third ratio we're looking at. So for Forest, here's the calculation, which we always do first. Quick assets, total current liabilities, again, coming from the balance sheet. I would note that. It was 0.7 last in year X2 and then 0.8 in X3. What that tells me is that is a favorable trend going up. What that 0.8 means is that for each dollar I need to pay current liabilities, I have 80 cents worth of those quick assets to do it. And my target in this industry, it says, is 0.9 to 1.3. Well, they have not achieved that. They're only at 0.7 and then 0.8. So even though this is an improving trend, they haven't hit the target, which is not a good thing. So what could they do in order to improve this? 2 things that I would write. So to make this better in the future and do the right thing, I could increase cash. So try to make the numerator bigger. So I could increase cash by selling stock. That would help me because my current liabilities would not be affected at all. So I would increase the numerator, which would bring that up. Or I could borrow more money, which would increase my long-term borrowing to pay off some of this current debt that I have. So that helps my denominator. So I issue some long-term liabilities which aren't in the calculation, and I pay off or reduce my current liabilities with that. So that is my final short-term financial strength ratio that I look at. So again, I had working capital, which was current assets minus current liabilities. And then I had current ratio, which was current assets divided by current liabilities. And then I had the quick ratio, which was the quick assets divided by current liabilities. So I will do another lecture that does the long-term financial strength ratios.